Hey guys, welcome to this video. Today I'm going to be showing you how you can become a millionaire over time by being consistently lazy. I know it sounds too good to be true, but it's not. All it is math and compounding. Compounding is essentially when you earn returns on your returns, or when you earn interest on your interest. The best way I can find to explain this is through a simple game. Would you rather take a penny that doubles each day for 30 days or take $1 million? Leave it in the comment section down below. If you take a penny every day and you double it for 30 days, after 30 days it turns into $5.3 million. That is the power of compounding. You can start with such a small amount of money, and over time, because your returns earn money on your returns, or your interest earns money on your interest, this can grow exponentially. Most of the growth happens towards the end. That's why it's super important to start investing as early as possible. So let's take this for example. You start with $100 today. The interest rate is going to be the return that you receive on your investments. Vanguard has done research on the different returns of different asset portfolios from 1926 to 2018. So as we can see, if you had a 100% bond portfolio throughout that time, your average annual return would have been 5.3%. However, if you were 100% stocks, your average annual return would have been 10.1%. So this is what we can use to assume the average return of the stock market over time. We can say it's 10%. The long-term average for inflation is around 3%, so we're going to use that as well. So what this essentially means is that your real return is 7%, because you take the interest rate that you get and you minus your inflation, and that gives you the real return on your money. Then we're going to put 40 years, or you can even put 35 years, so that anyone below the age of 30 this still applies to, and it can still work very easily. And let's say you contribute $10,000 every single year. Over 35 years, you would actually end up with $2.71 million. However, because of inflation, this actually turns into $1.38 million. So as you can see, I wasn't lying in the beginning of this video. By just investing consistently in the stock market and doing it passively, you can actually become a millionaire by the time you retire in 35 years. Now, if you're even younger like me, let's say you now have a 40-year time frame. This turns into $2 million. The longer time frame you have, the more money you can generate over time with compounding. It takes 25 years to get to 600,000, and then it takes 10 years to get to 1.4 million. All the gains take place towards the end, and the longer the time frame, the better. The more money you put in, so for example, if you're now to put into 20,000, in the same time frame, it's now 2.7 million. If you now make it 40 years, investing 20,000 each and every year, by the time you retire, it's now 4 million. The more time you have and the more money that you contribute, this actually leads to a lot more gains in the future. It can take you from going to 1 million to 4 million. This is why it's super important to start investing at 20, at 19, even 25, even if you're 30, but start now. If you wait another year, you lose one whole year of compounding. After 35 years, you have $1.38 million. But now if I make it 34 years, you lose 100,000. Like that's crazy. And if that doesn't make you want to invest now, I don't know what else I can tell you. Essentially, as you can see, start investing early and start doing it consistently. And you don't have to pick stocks. You don't have to spend your time in the markets. You can do this passively by buying index funds that track the stock market. The amount you can contribute depends on the amount of money you earn and the amount of money you spend. That's why it's basic personal finance principles to pay yourself first. So when you get your paycheck, the first thing you do is take money out of that paycheck and put it into an investing account and invest. If you do it at the end of the month, you're not going to have any money left over to actually invest. And this is what many people do, and it gets them into huge problems later in the future. Investing is prioritizing your future. The earlier you start prioritizing your future, the better. I'm going to leave the link to this calculator in the description, and I'm not gonna lie, I've spent so much time on this calculator, putting in different numbers, putting in different scenarios, seeing what the difference in interest rates does, and it's just crazy. And it can really motivate you to actually want to invest, because you can see how beneficial it is by starting now. So I really recommend go on this, spend like 5-10 minutes just inputting values. I'm gonna show you a more extreme example. Somehow you're super lucky and you increased your income a lot and you keep your spending very low, and you're able to contribute $40,000 a year. This turns into almost $8 million. That's more money than 99% of the world can see. And you can do this by just being lazy and passively investing consistently. This will never work if you're not consistently investing. There's a really amazing graphic that explains this super well. Time in the market is much more important than trying to time the market by trying to get the best possible entry in the market when the market's at the bottom and that's when you buy. No, if you miss 20 of the best days in the market over a 20-year time frame, the 20 best days, your return is negative. Right now in the market, there's a lot of uncertainty. No one really knows what's going to happen with the virus, and the stock market rally that we've seen could be potentially very illogical. So the best thing you can do is don't worry about what the short-term movements of the market does. Don't worry about that. Just invest and think long-term. Just buy and hold long-term. It doesn't matter how volatile the investment is as long as you hold it for a long period of time. It doesn't matter what the stock market does in 5 years or in 5 months or in 1 week. It matters what it does over 40 years. And the economy grows over time. So the stock market gets pulled up by the economy over time. Your money will grow and compound over time. It's much better to be invested than to wait and think, oh, I'll do it when the market crashes again and then I'll get in. Even if the market does crash, it's impossible to know when it's going to pick up again. Once you're out of the market, it can be very hard to get back in. In the Great Recession, for example, March 9, 2009 was the best day to get back into the market because that's when the market started to pick up again. But at that point in time, unemployment was at 10%, there was no confidence in the market, and volatility was sky high. Just invest now and invest consistently. Another basic personal finance principle is you don't invest money that you need in the short term. This is only money that you won't touch for the long term. I won't touch this money for 40 years. And that might be a conceptually very hard thing for people to understand. I'm going to invest this money and I won't touch it for 40 years. And I really hope that one person just looks at this graph, they're going to say, okay, over time, I'm going to start saving and investing my money. I'm going to fix up my personal finance situation. I'm going to reduce my spending, try and increase my income so I can contribute more. And over time, I'm just going to contribute every single month into an ETF portfolio and prioritize your future. This is how someone like Warren Buffett went from almost nothing to 88 billion because of the stock market. Sure, granted, his returns are way above the market, but the effect is still there. You might not reach 88 billion. You could sure as hell reach 1 million. You could sure as hell reach 8 million. I mean, this shows it right here. So, I mean, you don't have to listen to me. Go through this, input some numbers, and it's exciting. I know the current stock market situation is extremely uncertain. No one knows the consequences and the full effects of the virus, and the stock market rally that we have seen could be completely illogical, and maybe in the next 6 months there could be a crash. Maybe in the next 6 months the stock market could also go up another 10%. No one knows, and it's a fool's game to try and predict what's going to happen. The best way to take out fear of a market crash is to think of a market crash as a way to buy more stocks at a cheaper price. And when the market crashes, it's actually the best time to start investing because you can reduce the cost of your investment over time through a process called dollar cost averaging. You reduce the average cost of your investment in the times when the market crashes because you're paying a lower price. The purpose of this video is to show you that it is possible, that if you do take steps in your future to invest consistently and to contribute more and to try and increase your income and to reduce your spending, you could live a life of financial abundance. I'm not saying that this will be easy at all. The purpose of this video is to show you the potential of investing and compounding. And as you've seen, it is incredibly powerful and it can generate a lot of wealth over a lifetime. I really hope that one person who watches this video realizes that, okay, this is not going to be easy, but they start asking themselves, how can I increase my income? How can I reduce my spending? How can I contribute more? Because now they realize the power of compounding and the power to build wealth over time. Thanks for watching. If you enjoyed this video, smash the like button. And if you're new to this channel, you can check out the previous video I made on how to build an investment portfolio. Hope you guys enjoy. See you next time.